Hello and welcome to today's Factel Daily video. Start of another week. It's a Monday, and I'm only going to be joined by one person. Ryan Dibs, how you doing?
Yeah, good, buddy. How are you? Happy Monday.
I'm all right. You've been in a reflective mood over the weekend. You've been reflecting on the last 40 years of market action and how paradigm shifts take place, and you don't really know they happen until they've happened, really.
Yeah, exactly.
I'll tell you what I mean by that. So you draw a really compelling parallel between Japan's economic shift in 1989. As we know now, that was the peak in the Japanese stock market economy, I'm assuming. And in today's global economic situation, now, I was going to ask you, first of all, can you elaborate on why you think the US debt situation might represent a similar paradigm shift for investors today?
Yeah, so the basic point I was making with the Japan analogy at the start of today's piece was that with investment markets, sometimes for a long time something just works and it gets absorbed by the market participants. Everyone thinks that's the way to make money. For example, Japan was one of the fastest growing economies from the 1950s through to the late 1980s. Um, and it's hard to imagine how much these things get internalized at the time. Like everyone thought Japan would be the future. You know, I made a nod to the film Blade Runner in today's piece because if you look at how Ridley Scott and that was imagining the future, it was like Japan. LA looked like Japan by 2018. And obviously we know that didn't occur, but it's just amazing how much these things get internalized because they last for so long. No one in investing markets remembered when it didn't work. You know, another analogy you could give is Australian property. You know, ask anyone in Australia how to make money, they'll say property. And for most people's lifetimes, unless they experience the crashes in the early 90s, property's been the way to go. So I was using the Japan analogy as an interesting case in point where everyone believes something works and then suddenly it just doesn't. And that happens frequently in investment. It happens frequently over history, I should say. It doesn't happen very frequently in one's investing lifetime. And the thing that's happening right now, which is pretty massive and probably a bigger story than Japanese stock market, is US fixed income. And this is something we've talked about before. The US debt load is got to the point where people are thinking, have we reached a tipping point? Because for a long time, the way that investment professionals view markets is US debt, like fixed income, the US dollar is the risk free asset, the pristine collateral that underpins the whole financial system because US can never default on its debt. So if you want part of your portfolio to be safe, you put it in US fixed income. And that's what people have been doing for decades. We're reaching a point now where a number of big investors, different types of investors, are saying, we don't necessarily think that's going to be the case for the next few decades. So sometimes it's individual investors, like I referenced the billionaire Paul Tudor Jones, who came out with a statement last week saying that he owns no fixed income, no US fixed income. And then there's even nation states like Russia, the BRICS nation, Russia, India, China, who they've been tapering off their holdings of US assets or US debt, I should say, for the last 10 years. And sometimes it's hard to see that because it looks like their holdings are going up, but they're actually going up in nominal terms. If you adjust after inflation, they're reducing their holdings of US debt as a proportion of their overall assets. And so the broader point I was trying to make in today's piece was there's a fundamental shift happening, and you need to understand why that is and where is if the money is coming out of fixed interest, where is it going to flow to?
Yeah, it was interesting in today's morning meeting for the business. Greg made the point that he was looking at it over the weekend. Right, the deficit in the US is now 2 trillion, and I think at least half of that is just going on servicing the debt. I mean,
Yeah. So
I mean, we talk about debt a lot in this business, but I mean,
yeah.
there comes a point where,
But you know the funny thing is that when Greg was saying that, I was surprised that he'd only just realised that. And look, Greg's going to be ahead of the curve than most types of investors on looking at this type of stuff. And so it got me thinking, if he's only realising that, this is something people in Bitcoin space have been talking about for the last
yeah,
5 years. Because part of Bitcoin's value proposition is an escape from this overloaded system of debt. And so it surprised me when Greg said, "Oh, you just realised the scale of it." Not to put anything on Greg, because he obviously looks at this stuff a lot more than the mainstream. So if Greg's only realising it, it makes me think the mainstream are maybe behind the curve on this. But there's one thing that Greg didn't mention, which was Yeah, so the $2 trillion added to the deficit every year. The American debt is about 35 trillion, right? They're adding 2 trillion in deficits every year. $1 trillion, as you said, just goes on the interest bill alone, which is almost the same as what the US spends on their defense budget. So we're talking some serious numbers here. But even that understates it because there's another 200 trillion of unfunded liabilities that the US has to cover at some point in the future. So this is Social Security, Medicaid they've got in America, other payment obligations they've got in the future that they've not funded. So they've got to not just come up with servicing the debt, they've also got to come up with a way of funding these unfunded liabilities over the next, 20, 30 years as well. So if they're running deficits of $2 trillion a year and the unfunded liabilities are just getting more, how do they solve that situation? And it's got to the point where I think that's what investors are worrying about. They're saying, look, they know the US isn't going to default. They're not going to just say we're not paying back our debts, or you might think they won't. But will they find another way of defaulting? And that's what the crux of today's piece was.
Yeah, well, you mentioned Bitcoin. You also suggest three other key assets for the new paradigm, or the forward-looking assets: gold, Bitcoin, commodities, and select tech stocks. Which of these do you think offers the best opportunity for investors in the near term, and why?
Yeah, just quickly, I'll just come back to one point I should probably make. So,
Yeah.
why would an investor not want? In the past, an investor wanted to own US debt because it was a secure asset, right? It was part of their portfolio that was pretty safe,
And it's pretty
and
much underwritten by the US government,
it's
right?
underwritten by the government. But the investment angle, the important investment angle, where was that the interest rate was more than the inflation rate. So
Yeah.
even if you were only making a little bit, at least your purchasing power was at least going up a little bit, and it was safe, right? So it's part of a portfolio. There's some benefits of that, underwritten by the U.S. government, and even for foreign nations, the U.S. government was seen as a pretty safe place to put money. But things have changed in the last few years. The US government confiscated Russian US dollar assets, makes other countries like China and India maybe think, that's a bit worrying. But even for investors, you don't want to invest in fixed income if the inflation rate is going to be more than the interest you receive. Because otherwise, your money's just going backwards over time. That's like, me having $1,000 today and then putting in fixed income, and then in 10 years, I can only buy $800 worth of goods in the future. Like, what's the point in that? And that is the way that the US tries to get out of its debt situation. They try to run inflation higher than interest rates. So as Greg would say, nominal rates would be negative almost. And they'll try and do that. And they need to have the growth rate, the nominal growth rate of their economy higher than that. So that's the way that over time, this is what, again, historically, this is what empires have always done. They've tried to devalue their currency. Romans used to take away the gold component of their coinage. Britain's Henry VIII tried to do the same, and many other countries have tried it. Right, so that's why fixed income is now a place where investors should be wary of. The billionaire Paul Tudor Jones said he owns zero fixed interest, which is a pretty big deal. The BRICS are tapering off their fixed income exposure. Other investors are saying, do I want to own an asset which is getting inflated away and losing its purchasing power? Probably not. So then the question becomes, that's a $50 trillion fixed income market. It's huge. Now, even if just some of that flows come out, because there'll be some people that still own it for whatever reason, but even if just some of those flows move somewhere, it's going to have a pretty big effect. And that's where it comes to your question on the four assets. So where will that money go? Well, if it's trying to preserve purchasing power, which is what the sort of proxy for fixed income is, it needs to go somewhere where you've got a store of wealth asset. So you've got gold, which is doing really well right now with the price. You're seeing central banks buying gold. So that's almost telling you, well, that's what they're doing. They're replacing the US fixed income with gold. They're telling you that's what they're doing. So they're already doing that. You're seeing Bitcoin knocking on the door of all-time highs, and big financial institutions like BlackRock pushing it to their clients. It's been one of the best performing ETFs of all time this year. Record inflows coming into these new Bitcoin ETFs. Again, because Bitcoin has some store of value qualities which make it a replacement, or at least part of a replacement of fixed income, or even just part of your fixed income portfolio. So you've got gold and Bitcoin, the two sort of alternate store of value assets. Then you've got commodities, which, think about what a commodity is. Commodity as an end use case, if you're China, or a big economy that has manufacturing, you want to have commodities because you use them to create further value in your economy. And speaking with James Cooper, our geologist colleague, recently, he says that the sort of supply situation for commodities, the point we're at in the commodity cycle, is that there's not that much new supply coming on, and because there's been underinvestment in commodities for like a decade. So it's not just something that's happened over the last few years. So commodities are a natural hedge against inflation. That's the one thing. But also, if there's going to be a supply crunch and there's going to be, money printing on the other end, then commodities is a really, natural beneficiary of that. And according to James, the point we're at in the commodity cycle sort of supports that theory as well. So
Yeah.
I think that's for me. I've got a lot of my super money in the commodity side of things. And the last one would be like tech. Tech's always been a natural growth industry. I made the reference in today's piece that when Japan wasn't the place to be, something else took its place. The new paradigm was .com stocks. Not that anyone really appreciated it in the early 90s, but that's where the biggest returns were to be made. If you'd managed to jump off the Japan trade and move into the .com trade, you would have cleaned up.
There was another point you make as well, that you make the point that just because the last decade that happened doesn't mean it's going to happen. But if you look back in the last 15 years, it's been all about the tech, the big tech stocks. But is that why you say it's probably smaller tech or?
Well, again, there's been an interesting change. I didn't write too much about this in today's piece, but there's been an interesting change in the dynamic of big tech as they're trying to capture this AI opportunity.
Yeah.
They're investing heaps of money in data centers, right? And it sort of changed their business model. The business model of a big tech company was low capex. They weren't spending a lot of capital expenditure, and they would make these rivers of cash through subscription revenue and the big cash flow generating machines, which they would reinvest. With the AI opportunity, they're sort of investing heaps of money into data centers, electricity, even nuclear exposure with some of the big two like Google and Microsoft. And that is really capex intensive. So they're I think one report I read said they trebled their capex expenditure, right, in data centers. So that changes the model for an investor. Because remember, these things have depreciation as well. You set up a brand new AI chip factory with NVIDIA's latest and greatest chips. In 5 years, that could all be depreciated pretty far down, and you have to replace all those chips again. So they're really making a big play for the AI opportunity and trying to own the infrastructure behind it, or at least promote that infrastructure. But as an investor, that brings a bit more risk because they're not the cash flow generating machines anymore that they once were. The return on equity, you don't know. That's a bit unknown because we don't really know how much money they're going to generate from AI. Will they be the ones to capture it? But that's why I think the opportunity is interesting in the smaller AI players or the smaller companies that might look to leverage the capabilities of AI to make money off it without having those same capex expenses. And that's pretty much what happened with the .com stuff. In the early days, everyone said, "Oh, I want to own Cisco or whoever's creating the fiber optics and the poles and wires," right? But they weren't ones that made money for people. It was Google who just built a search engine on the back of it, or Microsoft who sold books online, or it's the people who make use of the tech and create the new business models. And I think that's where my thinking would be at some stage. Right now, look, it goes through stages. So right now, you want to own some infrastructure because they'll probably be the first ones to benefit in the terms of the hype cycle. But always keep your eye out for other innovative new companies coming through. Because if the lesson of the .com showed us anything, it was when those like consumer-facing applications and breakthrough applications come, it spurs this frenzy of innovation and adoption, and that's when you get the 1999 era of the .com boom, and then maybe the 2000 bust. But it's an exciting place to be if you're ahead of the curve.
Well, it was a fascinating conversation we were having late last week, in one evening when we had a chat with one of our colleagues in the UK. Right, we're basically saying that. Just as certain people are getting fed up of the monetary infrastructure of US hegemony, the big tech companies, they're almost becoming big energy companies, aren't they? Because but that's probably a whole other discussion.
But it's a whole other discussion. But the point is that energy companies are a different business model than a software selling business. And and look, even last week I don't even know if it's a bad thing or a good thing yet, but it's a change, and it's a change where they have to put more money in the front to potentially try and get some out the back. But that's a bigger risk. The current model, the software model, they didn't need to put that much in to scale. They could scale quickly. They could test something, and if it worked, scale it massively. But if you're relying on data centers and energy to scale, that's a lot of investment you've got to make before you even know if things are going to scale properly. You have to have the infrastructure there because you can't scale straight away unless you have the data center there. So they're taking a risk on the AI stuff, which I think is both a good thing for AI in general, but maybe not a good thing for the big tech companies because they're the ones taking a lot of the risk right now.
Paradigm shifts everywhere.
Paradigm shifts everywhere you
What?
look.
Yeah, and yeah. What specific characteristics would you look like? So you're obviously you focus on the crypto market, but also in the tech sector as well. That's where a lot of small cap disruptors kind of play,
Yeah.
and that's where more you're interested in. And I know our colleague Callum Newman is also interested in that same way. But if you're gonna go for bang for buck as an investor, you've got a small bit of capital, risk capital. Say you've already got a position in your big tech plays for the longer term. But what sort of characteristics would you look for? Should investors look for in smaller tech companies that are looking that could be prospects for to be gobbled up by the big ones?
Yeah, look, what you really want to see, and I gave one example in today's piece, is like uh, uh, early indications of product market fit, of getting traction with you. So if we're talking about AI in general, there's a
Yeah.
company I referenced called Dave. Dave, it's called Dave. I'd never heard of it before. It was a small US fintech, right? And it's
Right,
up
Dave.
700%
Yeah.
this year. And it's just a fintech mobile app that, its rationale is to bank the unbanked, right? Now, I've been around fintech for a long time. There's always apps that want to bank the unbanked. So there's nothing specifically great about that thinking, right? But what they've managed to do is they adopted two aspects of AI into their product. They adopted a chatbot to do the customer service, and they adopted a credit assessment AI engine to help do better credit decisions, to basically pre-qualify people for loans. And they did it in a way using the person's real purchasing behavior from the app. So they used the data from the app to make the credit assessment decision in real time with real data, and they didn't use the traditional credit scoring method, which is what a lot of traditional finance companies use. So they didn't worry about that. They just said, we're just going to use the data because we can see what transactions you're making, we can see your income, expenses, your bills, and we're just going to let our AI engine work that out. On the chat bot customer service side of things, so what AI has done for this company and why it's up 700% for the year is just by adopting AI into their product, they've seen their revenue grow 70%. At the same time, they've seen their expenses
Their
drop
cost
25.
structure go down.
Cost structure goes down 25%, revenue went up 75%. And so far, at least in its early days, I wouldn't necessarily say this is definitely what the situation, but so far their lending has been better as well. That their sort of late repayments have gone down from 2.5% down to 1% and a bit. So far, they have a small company it's not created AI, but it's adopted the technology. It's doing more with less, and it's getting growth with less. And that's what good innovative companies will do. They'll see what the tools are available, and they'll do more with less, and they'll get growth with less. They'll leverage, and that's the same as what happened with the .com. The person that worked out how Google's search algorithm worked best could grow their company fast at first. The
Yeah.
opportunity was there for a limited amount of time. Dave so far is making progress, and shareholders have rewarded it by putting up 700%. Now, it's gone up from a company under 100 million cap to like a $500 million company. I'm not saying it's a good investment now, but it's interesting for me to keep an eye on those situations because that's an example of a lot of people say AI is all hype, but doesn't actually add any real value. Well, so far this company's showing to their business it is adding real value. If they can continue it, that spurs other companies to look at it to see, well, how can we add that capability? And like you said, when you get these companies, small companies that do really well, big banks and that are not going to change their procedures in a hurry. You know what I mean? They're not going to adopt what Dave's doing in a hurry because they've got too much, overhead, too much sort of what they call it. You just can't change quickly. Just being a big company, so they might look to buy these things out in future, or they might get disrupted, like what happened with a lot of retail and other industries in the .com stuff. So, I think that the most important thing is not a financial metric. It's more of a product market fit. It's almost seeing what products are getting daily active users, growing their user base really fast, showing that they've got a product people want, or a business that's showing how it's using the tools to make their bottom line better, increase their growth rate, stuff like that. That's sort of what you're looking for, and you're looking for the more of these stories come, the more it proves that the AI is on the cusp of going more mainstream because
Yeah.
success begets more success. So
Well, let's end on something going more mainstream. So let's just switch back. So I want to just ask you one thing about there's an element of back into the crypto land and bit of Bitcoin in this, and also it's kind of chimes with bigger companies doing newer things. So Microsoft shareholders voting on Bitcoin adoption. You mentioned that.
Yeah.
How do you see corporate cryptocurrency adoption potentially evolving, and what implications might that have for traditional portfolios?
Yeah, so that's a huge story, and like I probably wanted to lead with that story today, but the more I thought about it, I wanted to broaden it to a bigger
Yep.
issue. But yeah, so Microsoft on the 10th of December, there's a little line item on the regulatory filing that there's a shareholder vote on invest. It just says investing in Bitcoin, right? And I'll be clear, the board are against this proposal, but someone, and it must be a fairly deep pocketed shareholder. My money would be on BlackRock or Fidelity, who both have Bitcoin ETFs. But someone has put that on the agenda, and they've gone through the various steps you have to do. It's not like anyone can just put something on the agenda of Microsoft's meeting. You have to, be able to know how to navigate that process. So they put that on the agenda, and there'll be a vote on should Microsoft consider investing in Bitcoin. Now, Microsoft have about 75 billion in cash just sitting there, and like we talked about at the start today, that's 75 billion going backwards in value over time. So this is a real problem that these big tech companies have. They're sitting on mountains of cash that goes backwards over time. They need to invest it somewhere. Now, MicroStrategy, so not Microsoft, but MicroStrategy is another US company that has been pursuing a Bitcoin
Well, they
treasury.
pondered that question 4 or 5
4
years
years
ago.
ago, yeah, and they're actually they don't get much airplay in the mainstream, but they're the fastest growing company in terms of value over the last 4 years. They've made more money for shareholders than Nvidia has. They've just rocketed into I think the top 200 companies in America, and they've done that by simply buying Bitcoin and putting it on their balance sheet and finding ever more creative ways to do it. And you've got to remember there's a bit of game theory in play. If your competitor, if MicroStrategy keeps on going up in value, other shareholders will be like to their company directors, what are we doing? This guy over here is making a heap of money for his investors and we're not doing it. And because it's Bitcoin, there's a lot of, sort of people stuck in their own opinions on it. But as if this vote somehow is positive, if 51% of shareholders vote yes to this, that is a sea change in the next step of Bitcoin's evolution, because then if Microsoft are even considering it, then Apple has to consider it. Facebook has to consider it. And look, you speak to some of these or you listen to some of these big tech CEOs, they're not necessarily against Bitcoin, but they're just they're just a bit wary of. They do pretty well in the existing system, so they're wary of like stepping out of line. But if it becomes a common thing to do, then you will see big companies with big cash balances look to diversify some of that inflation risk that they're all running right now by putting some Bitcoin on the balance sheet. And if that happens, game theory says you've got to keep buying in the price and get to the price level.
That would be big news if Microsoft decides to
Yeah,
do that.
people have ignored MicroStrategy, even though it's the best performing stock for the last few years, but they're not going to ignore Microsoft if they do it. So that's interesting. Look, but behind the scenes, even if they say no, the fact that it's on the agenda means the board members who vote no to that have to go on record to say they voted no and be answerable for that decision 3 years down the line. So I think it makes people accountable at least. And I think it'll be interesting to see if that happens. But whether it does or doesn't, the bigger story is probably MicroStrategy will keep pursuing its strategy. They are potentially, I think they report their next results on the 30th of October, which isn't long, few days, right? Now, if they opt to change their accounting method to a new FASP accounting method, which basically means they can book a profit on their Bitcoin gains, that's the last hurdle they have to clear to be potentially qualified for inclusion in the S&P 500 index, right? Now, it's up to the S&P 500 index whether they include them or not, but they basically meet all the criteria if they do that. If they get included in that index, there's trillions of dollars of index funds and other managers that will have to buy MicroStrategy shares because they have to keep a weighting in line with the index. If that happens, that pushes up MicroStrategy's share price. MicroStrategy today have been using their share price to raise money to buy more Bitcoin. So in theory, they get into the S&P 500, everyone bids their share price up. Michael Saylor uses that to issue more shares, buys more Bitcoin, price of Bitcoin goes up. So there's a really interesting story, and I think we've talked about it before, or I've definitely written about it before, but there's this real interesting strategy MicroStrategy are pursuing, which is basically using Bitcoin to eat the stock market. And that, whether Microsoft comes on or not, MicroStrategy is still going to keep on doing that. So definitely the place to watch for the next 3 months. Corporate adoption of Bitcoin could be the biggest story of 2025.
There you go. Well, that's a really good place to end there, I think. Look, we've traversed lots of different topics. As I was listening to Donald Trump's interview with or conversation with Joe Rogan, and his
Yep.
his whole thing is that he likes to weave stuff, and I feel like we've weaved a lot of topics and trends and
Hopefully.
paradigm shifts. We've gone from Japan to tech stocks to back to crypto. Anyway, it's been fascinating as always, Ryan.
Yeah.
If you
Thank
if
you.
you if you'd like to read Ryan's original piece, it's all in there today. It's a longer piece than normal, but it's well worth it. The link is in the description below. Do have a read. Hit the like button. I think all these things make a difference. I assume they do. But yeah, and subscribe to. We've got 19,000 YouTube subscribers now, which is great. Let's
Nice.
just keep this going. Be good to spread the word of fat tail ideas because they're just more interesting, in my opinion. What do you say?
Sounds good. I agree.
Yeah. All right, Ryan, mate. I will talk to you next Monday. Have a great week, and for those at home, see you tomorrow.
Cheers.